Hello, everybody, and welcome to our second webinar regarding UPS financial planning strategies. My name is Tyler Vernon, founder and CEO of Biltmore Capital Advisors. As many of you already know, I've been working with UPSers for over 20 years now, and my team and I have built a financial planning practice catered to the UPS community. We've worked with many of your partners over the years, educating them, preparing them, and partnering with them to develop and execute their financial plan customized to their unique set of needs, tax issues, opportunities, and risks. It's been a great ride over the years, and we've really enjoyed working with the UPS community. When we speak to UPS employees, while UPS is really an amazing company for so many reasons, some have a concern about the concentration risk in having most of their net worth tied up in a single stock, even though it's UPS. While there are many strategies to hedge that risk, today I'd like to speak to you about one of the most common strategies, that being outright sales of the UPS stock as a strategy to reduce concentration. Now, when we talk about outright sales of UPS with our clients, we already know the next question out of our UPSer's mouth, right? You probably know what it is. How do I recreate that UPS dividend? It's a great question. It's one that we've worked on for 20 years, and that's why I wanted to spend some time in today's short video to discuss it. UPSers over time have been so used to that dividend. It's one of the great benefits of being a UPS shareholder. The management team has committed at this point to not only keeping the dividend stable in hard times, but they've increased it steadily over the years, and it's outpaced inflation. If you remember back in the year 2000, just after the IPO, the dividend was 17 cents per share. I actually had to go back and look at that, and I remember. 20 years later, it's over $1 a share. Dividends have been a great way that UPS has rewarded shareholders that differentiates the stock from rival FedEx. And it's no wonder why UPSers who have concentrated holdings of the stock want to understand how to create that dividend and cash flow. Today, I want to discuss that one way that Biltmore handles this for our clients. As an example, I want to take somebody with 10,000 shares of stock. Now, you may be watching this video and have over 200,000 shares or only 2,000 shares, and it really doesn't matter. The math all works out the same. 10,000 shares just seemed to be a good round number for this conversation. So, as we look at that, 10,000 shares at today's dividend of $1.01 a share, and again, they should be increasing the dividend very soon. That's $4.04 a share. That's over $40,000 of annual income on that 10,000 shares. With a stock that's trading around $165 as we speak, that's just shy of a 2.5% dividend payout. Now, I want to bring you through this example selling plan for a fictitious client by the random name of Jim Casey. God rest his soul. So let's dive into that. 2,500 shares in this fictitious client's selling plan are to be sold. But this client wants to wait till $170. They want to get a little bit more juice out of it. The stock has hit 170 in the past, and it just seems to be a good mental target for diversification. So in dollar terms, that's $425,000 worth of UPS in the sale. So let's say in this example that this person has an average cost basis of $120. So that's a long-term capital gain, meaning that it was held for over a year of $300,000. For example reasons, let's say that they have a state tax of 6%, it's around where Georgia is, and a federal capital gains tax rate of 15%. So a 21% all-in tax rate on the gains of their UPS stock. Now keep in mind, these numbers are very important and can change depending on the state, your taxable income, current laws at the state and the time, and other factors. And so most of the time we want to bring your CPA in the loop when we make some of these assumptions. But as per the below, the capital gain will be about $50 a share on the 2,500 shares, or $125,000 capital gain. At a 21% tax bracket, that would make the tax $26,250 that would be paid to Uncle Sam, leaving the dividend reinvestment proceeds at just shy of $400,000, about $398,750. The dividend loss on the 2,500 shares is about $10,100. That's what's gone once they sell. Now, for many of you UPS families, we not only want to replace that dividend, but for many families actually increase the cash flow when you go into retirement. Because as you know, for people that qualify for the pension, your pension may only be about 60% of your income when you're working. So we want to find ways to increase your cash flow, and this is one of many. So let's dig in and talk about how to increase and enhance that cash flow. Many UPSers come to us, and this is a very frequent conversation, and say that they need dividend-producing stocks to do this. So in this example, that if their dividends on UPS were paying $10,100 on the 2,500 shares, that they want to come up with stocks that will pay us at least that $10,100. Now the problem in this is that there are many companies that may be great companies that don't pay that 2.5% dividend. So if you think as a funnel of all the stocks in the marketplace and 2.5% dividend rate as this funnel, and only stocks that paid that or more would pass through, there are most of the stocks in the universe that would not be included. So I want to drive that in a little further for maybe some of you who don't follow the market as much. So let's look at some stocks back in 2020 and the impact that they had on the S&P 500. So Apple, Amazon, and Microsoft, those three alone, if you just look at their performance, those alone allocated 16.5% of the returns in the S&P 500 for the year. Even though there were only small pieces of the S&P 500, because of their performance, they played a huge role in the return of the index. Amazon was up 76%, had no dividend. Apple was up about 82% with a dividend yield of 0.6. And Microsoft was up huge with a dividend of about 1%. I could go down the list of stocks that had spectacular returns in 2020. Granted, it was 1 year, but that just couldn't be included in this hypothetical portfolio because they didn't have the dividend yield of 2.5% or more. So I want to take this a bit further, and if you take a look at the screen, I want to share with you an index of high dividend paying value companies. Typically, some of the companies that I just mentioned are growth companies. They're growing their earnings. Now, typically, value companies have larger dividends. And if you look at this area in the market, specifically large cap value, you see that that area of the market was up 2.8% in 2020. Now, if you look at the large cap growth counterpart, again, the large growth oriented stocks in the United States, they were up over 38%. Now, these companies typically don't pay big dividends. Now, to the other side of the screen on the left, you'll see that over the last 10 years, these large cap value dividend paying companies in general, they've done about 10.5% per year annually over the last decade, including the dividend, versus large cap growth companies up 17% annually. So you would have had about 7% annual outperformance by having large cap growth stocks in the portfolio. So while you got your dividends, if you had that concentration in value, you greatly underperformed the broader markets and left a lot of opportunity on the table. I'm not saying that you concentrate in large cap growth companies. Quite the opposite. You want to stay very diversified. So let's take a different view on this. And I want you to think about the UPS pension plan and what the pension is there to do. Right? They need to create enough money and returns each year to give out to the retirees and also keep up with inflation. Forget the contributions paying into the pension for a minute, which is sizable that comes from earnings. But just for the simplicity of the conversation, let's say that they're pulling about 4% of the pension a year to pay the retirees. Do you think the investment committee sits around and says, let's only look for stocks paying at least 4% or more in dividends? Again, that would create this funnel that I mentioned before, and it would give us only a small, very fragmented part of the equity markets if we did it. And most stocks wouldn't qualify to go through that funnel. So instead of having a funnel of maybe quality companies that not only pay dividends, but some that are poised for growth, you're automatically just throwing those other opportunities away. And to take it a step further, and believe me, this doesn't exist, but hypothetically, if there was a stock that was guaranteed to go up by 10% a year, but paid no dividends, that couldn't be included in the portfolio. So I think you understand, the point that we're trying to make, in that we don't want the dividend tail to wag the dog. So what do we want to do? We want to look at creating returns in the most diversified and best way possible, given a unit of risk. So let's say that in our financial planning calculations up front, before we do any diversification, that we determine that you need a 3.25% distribution rate out of your after-tax proceeds of your UPS stock, right? So you need to pull 3.25% out of your liquid portfolio to hit your retirement needs in this example. And that your risk tolerance is moderate aggressive. And maybe we define moderate aggressive as a portfolio of 70% stock and 30% bonds or more conservative type of assets. And that should get you to the promised land, in your long-term retirement goals. So in the stock portion, you have some stocks which are paying higher dividends than UPS, and some that are paying lower dividends than UPS. But as a result, your dividend yield was 2.25% in your stock. But to solve for cash flow needs, as I talked about in retirement, you need to pull out 3.25% out of that. This means that on an annual basis, we need to pull out about 1% more out of the portfolio than the dividend is actually paying us. So on a quarterly basis, it means that the portfolio manager has to find a place to shave off 0.25 percentage point of growth of the portfolio every quarter to keep up with that 3.25% withdrawal rate. Now, we've obviously been through a great time in markets over the last year, barring a coronavirus, which thankfully was short-lived as it related to markets at this point. But these type of portfolios may have grown on an average of 7% annually. So if you think about somebody taking their 3.25%, but the portfolio growing at 7%, they still had a larger portfolio in the future. Now, one of the positive things about this is that it forces the portfolio manager to actively rebalance. As I speak to you here in 2021, and as I alluded to, over the last several years, we've been selling that large cap growth area of the portfolio for clients to reach that distribution rate, in this example of 3.25%. This is that area that I mentioned a little earlier that has outperformed the other areas of the market annually and has been growing at 17% over the last 10 years. And what it does is it forces us to trim those areas of the portfolio that have done very well to help keep risk aligned so we don't have any area of overexposure. The returns have easily made up for the distribution rate in this example. In April, during the coronavirus, when clients needed that cash flow, but the markets were down, in some cases, we didn't want to sell 0.25% of the portfolio and of the stocks that were down. So we sold off some of the bonds that in some cases rallied during that time, forcing us to get in a good pattern of buying low and selling high. So getting back to that selling plan, you can see in this example The client sold 2,500 shares of UPS stock. They lost the $10,100 dividend, right? Because they sold. They paid their taxes. But the distribution rate was 3.25%, so their cash flow actually increases in retirement. In this example, cash flow increased by 28%. So now they have a diversified portfolio with investments because they have some bonds which can rally in a market pullback. They have diversification in the stocks that can do well when growth stocks are moving. They're in markets that will also favor dividend-paying value stocks when they're in favor. Again, a very diversified portfolio that was carefully thought through and addresses the cash flow needs for our clients. I hope you found this conversation valuable and that you enjoyed the short video. And as the UPS community knows, we have an open door policy here at Biltmore Capital. If you'd ever like to have a conversation about your specific situation, how to address your concerns, or learn more about our firm, we're always here and open to have a private conversation. Thank you.